All right, so we just mentioned some of the declines when it comes to Indian equities, ETFs. This meeting with Modi and Trump, how important is it when it comes to the investment thesis when it comes to India in your mind?
I think it's really important, and we've been getting a lot of attention around our NDIA product this week, and investors are just keeping a really close eye on it because we think that this event not only represents an opportunity for Modi and Trump to sort of cement the legacy of their relationship, potentially improve trade, and clarify that they're on the same team, but it's also an opportunity for Modi to continue courting foreign direct investment from everyone from the likes of NVIDIA to Microsoft to Boeing. And we've had a lot of other things happen earlier this year, which has kind of kept the markets on edge. And now that we've had the domestic elections behind us, the new budget, the RBI moving forward with its first rate cut, this seems like the last remaining catalyst before investors can jump back into India's market.
All right. One of the concerns about investing in India is slowing growth there. Let's just say hypothetically, if there isn't some type of deal to give exemptions on tariffs for India, what does that mean for these ETFs? Are there individual stocks perhaps that are more investable? Are there parts of the Indian market that become more investable despite the tariffs? Or does the complete thesis fall apart?
No, I think the thesis is still there because India is largely a domestically driven growth market. It's not unlike a lot of countries in Latin America or other areas, and specifically out of China, it's not as dependent on exports as other countries are. So India's thesis is really based around very attractive demographics, strong governance, and in addition to that, really benefiting from the headwinds that are coming into China as companies look for supply chain diversification and moving into India. So I think there are opportunities there. From a fundamental perspective, the market's been a bit volatile over the past quarter. I think active management is really helping. We saw the broad fraud allegations against Adani companies, which make up, I think there are about 5 to 6 companies in the index. With the active management, you're able to kind of dodge some of those bullets and find opportunities in the strong, fundamentally driven stocks that have sold off over the past quarters. So we like names like Go Digit Insurance, Prestige Estates, Axis Bank, and really heavily more into financials and other sectors at the moment.
Malcolm, I want to turn to China right now. This week, we learned that David Tepper's Buy Everything China bet just continues to pay off. Appaloosa boosting its holdings in Chinese tech stocks and ETFs in the fourth quarter. And the company caught the DeepSeek bounce back in January. And a note this week, Goldman Sachs is adding that hedge funds, they've been snapping up Chinese stocks throughout the year, making them, and this is a quote, the most notionally net bought market. I want to get your take on this. What's your view? Is this Buy Everything China strategy? Is this a sustainable strategy? We've seen a lot of ups and downs when it comes to Chinese equities over the years.
Yeah, it's a good question. We at Global X, we highlighted China as a top contrarian investment for our 2025 outlook. And that's really based off of low positioning, discounted valuations, and incremental signs of government support, really all driving positive signals for the market. But however, when you think about it, I think the Buy Everything China strategy is more of a trade, and that there are other areas within China, specifically China consumer, that's more focused approach to a long-term opportunity that benefits from clear alignment with the CCP. Broadly speaking, the other areas within China, I think you've got a shorter time frame, and I think you're probably going to see some profit taken based off of that.
All right, so Malcolm, you call it a trade. You say it's not actually a sustainable investment. When you get off of this trade, is there something coming up that you think might be an inflection point where if investors, they want to ride this David Tepper bet, that they might want to look to get out? Is there an economic report or something else coming out?
It's not so much about waiting for a specific catalyst. I think it's what you're not seeing is more of the lack of certainty in China's market. We know short term that incremental stimulus is coming out. We know that valuations are still attractive, and we know that there's still a lack of positioning in the market. So as we start seeing flows come, as we start seeing mean reversion in terms of multiples, then I think you're going to start seeing some profit taking coming into other countries, possibly India if we look at it this week, but also within China. I think people are going to move more towards the consumer sector. And that's really because when you look towards what China's goals are and what the CCP wants to do, it's kind of now no longer be a factory to the world or a manufacturing center for the rest of the world, but drive their economy based off of consumer-driven domestic growth. So that's why we're really more focused on the consumer segment within China. If you look at a fund like CHIQ, you're getting diversified consumer exposure across big internet, autonomous driving, travel, education, and gaming. And I think this shows really clear alignment with the CCP's goal to double the middle class by 2035.